Everybody in Kenya will tell you to put your money in a money market fund. Okay, but which one? Because the gap between the best fund and the worst one, right now, is more than double. And the tax man? He quietly takes a cut before you even see a shilling. So today, no hype, just the real after-tax ranking for 2026. Oh, and the fund most Kenyans actually use? It's near the bottom of this list. Stay for that. Here's the thing nobody screenshots. Every best fund video shows you the gross yield, the big number. But money market interest in Kenya is taxed, 15%, withheld, automatically. So that flashy number, it's never what lands in your pocket. So all day today, we're talking net, what you actually keep, because that's the only number that pays your rent. Right now, as of June 2026, here are the funds paying the most, after tax. Nabo Africa, 11.7%. Saiton, 10.2. Etika, 9.1. Lofty Corbin, 9 flat. Madison, 8.9. Nabo and Saiton are out front. But, and this matters, the very top of the table is often the most volatile. A fund that's number one this quarter can slide next quarter. High yield is one signal, not the whole story. Hold that thought. Now, the fund most Kenyans actually use. You bank with Equity, or Stanbic, so you just click their money market fund. Feels safe, right? Equity's fund pays about 4.4% after tax. Stanbic, 4.5%. That's less than half of the funds at the top. And here's the gut punch. Inflation in Kenya right now is 6.7%. So in real terms, that safe bank fund is losing you money, while it just sits there. The fund attached to the bank you already use is often the worst paying one in the country. Convenience has a price. Quick reality check, because we don't do hype here. A 91-day treasury bill is paying about 9% right now. The average money market fund? About 9% gross too. They're close. The difference is, the fund lets you withdraw in a day or two, while the T-bill locks your money for the term. So, money market fund for cash you might need soon. Treasury bill for money you can park. Different tools, different jobs. So don't just chase the top number. Before you put in a single shilling, run the 5-point check. 1. The net yield, after the 15% tax, not the headline. 2. The track record. Is it consistently near the top or a one-quarter wonder? 3. The fund house. Who runs it? How big are they? And are they regulated by the CMA? 4. The minimum and the withdrawal speed. Can you start small and get your cash in a day or two? And 5. Your own timeline. Money you need in weeks shouldn't chase the same fund as money you won't touch for a year. Tick those 5 and you're not gambling. You're choosing. That's the whole game. So that's the honest 2026 ranking. Net, not noise. If this saved you from your bank's lazy fund, you know what to do. But here's the real question. Once you've picked a fund, how much should you actually put in, if all you've got is 10,000 bob? Because the amount matters less than you think. I break it down in this one, next.